Welcome, Johan.
Thank you so much.
To my understanding, you are currently conducting a specific study on investor relations.
Yes.
Could you perhaps start with just telling the listeners what is investor relations?
Yes, I think that's a good way to start. So I'm currently doing 2 research projects in parallel that has a lot of overlaps. So one on investors and how their decision making, basically how they come up with their investment ideas, how they buy a share, sell a share, and so forth. And then the second project, which we'll be speaking more about now, is that on investor relations. And that is a bigger program that we aim to develop here at the school. We try to develop more teaching on investor relations, more research projects on investor relations, because it's an area we think is a little bit underexplored, but is very interesting, and a lot of things are happening at the moment. So investor relations is the function in an organization, typically a listed organization, that deals with the investor, obviously investor relations, but the relationships with the investors. So they are typically very closely organized to the top CEO and CFO, and they connect the top management with relevant investors and analysts, and to some extent debt investors as well. And then they're responsible for setting up meetings, communicating the equity story, making sense of accounting information for relevant parties. Basically being the intermediary between top management and the capital market.
Right. Okay. And why do you think you are particularly the person that perhaps should focus on doing this kind of research? So what sort of led you into doing investor relations research?
So originally in my PhD, I conducted research on capital markets and qualitative research on capital markets. Back then it was on sell-side analysts and how their organizational context impacted their behavior and decision-making as well. So I've always had a strong interest in kind of the relationship with accounting and finance, and how accounting information is used in capital market practices. And on top of that, I'm also very, very curious about financial communication. I'm teaching a course here at SEC, a master course on financial communication, and how we tailor and frame accounting information to reach to achieve what we want to achieve with it, to have people change their behavior, take action on it. And I think investor relations is interesting in that sense. It's certainly a hybrid profession. People who work with investor relations come from many different backgrounds, but it's partly about being very strong with accounting and being able to tell a story around the accounting numbers and knowing what's relevant in the accounting information. On top of that, you also need to have a finance knowledge. You need to know what these users use the accounting for. How do their practices look like? What do they appreciate? And on top of that, you need to be a communication specialist. You need to know what works, what doesn't work. And on top of that, of course, you need to be very, very social. So there are a lot of these dimensions that I find very interesting from a research perspective.
It sounds like a really, really tough job to perform. A lot of different sort of skill sets you need to possess.
Really, it really is.
And why do you think accounting is the right discipline to investigate investor relations?
Yeah, well, as I said, it's a hybrid profession, certainly. So there are different angles on it. But it's so clear that, first of all, a lot of investor relations people come from an accounting background. They come from other backgrounds as well. But it's also so closely tied to the accounting reports. The entire profession is kind of organized around these quarterly report releases, the road shows that follows that. So it really is a profession of the use of accounting, making accounting relevant, making it useful for others. And if I look, so one of the research projects I've been conducting now is the history of investor relations. I've been interviewing the very, very earliest investor relations officers in Sweden from the 80s and onwards. And it really emerged in relation to accounting information, especially, the report releases. How do we make sure that investors get what they want in relation to the accounting reports?
That's really interesting. Do you have any interesting anecdotes from these people you have met?
Oh, a million. As I said, they're so social. So it's been the best interviews I've ever done. It's been so much fun. And a lot of these people really say that it was typically early in their careers. They were often quite young, late 20s, early 30s, and they often remember this very fondly. A lot of fun. They were young and hungry. They got to do a lot of new stuff. So it's been very interesting interviews.
Sorry for interrupting you, but is it so most of them are, I guess, early 80s, early 90s, or when did they start their career?
Yeah, so the very first investor relations officer was 1981. It was Mats Ödman. The company then was Fortia, but it's later Pharmacia, so pharmaceutical company. And then 83, it was ASEA, later ABB. And then a handful during the 80s, whereas in the early 90s, it really took off. And then in the early 90s, they also started an investor relations association. So showing that it had become a grander concern in Swedish practice.
Okay, and in this study, do you interview any current investor relations officers or?
Some of them who started early 80s are still working with investor relations, either as consultants or actually as very senior investor relations professionals. So some of them have spent their entire careers, 40 years or so, doing this, which is quite wonderful.
Right. Yeah, and that's interesting. I guess you could get, for the people who have stayed in the business or in that specific role, I guess they will have a clear understanding of the development of the profession over time, from the 80s up until today.
Yeah.
But perhaps this is a bit too methodological question, but it just got me thinking. If you have, let's say you have done 20 interviews, and 17 of them left after 10 years, and then 3 is still doing this.
Which I think is a quite fair description of the sample.
Yeah, okay, that's interesting. But do you feel like you would have to sort of top it up with a couple of more current investor relations, or are you simply in this specific study interested in the history of?
Oh yes, the emergence of the profession. So the research project will be much larger. So starting in the fall, I will start to conduct focus groups with current investor relations officers to really see what's on the agenda right now, what is the concern, what's happening, and so forth. No. So I'm not done yet. But in this history project, it's more, okay, why did Swedish companies start doing this? How did they innovate when this was really happening? So it's partly, I think it's 22 interviews in total, which actually covers a lot of the early 80s, 90s investor relations officers, and then a quite significant search of archives, news reports, books, etc., to see how was this discussed back then. I want to give an anecdote though. You asked me for an anecdote, and so I interviewed Mats Ödman, who was the very first in Sweden, and he's given me. He said I can recommunicate all of his stories however I want. So I know that I'm in the safe here. Yes. How the first investor relations officer in Sweden, how that came about. So Pharmacia, as many other companies around this time, they started to engage more internationally, and they were listed in the New York, or were aiming to be listed. I don't remember exactly the dates, but they were interested in the American market and wanted American investors. They believed, as many others, that the Americans were at the time doing better analysis of pharmaceutical companies, giving them a fairer valuation. And then he said, so he was kind of in charge of organizing a lot of this. And then they had invited a big group of American investors, quite famous investors. And then they had this meeting in this conference room, and it was just packed. So when he had organized everything, he didn't even have a seat at the table because it was so packed. So he found a single chair and sat by the door. And then the CEO back then, he started to present the company, and the investors would listen, he thought. But then the famous guy said, wait a minute, before you continue, who's your investor relations officer? And the CEO was like, it's Mats over there by the door. I think that's a wonderful story. That's the emergence of Swedish investor relations.
It sure is. And it's interesting. So I guess, as with most of these kind of things, the US was ahead of Sweden.
Yes.
So they expected the IR officer to take a bigger part in that presentation.
They were so, not necessarily in the presentation, but they were so accustomed to have one person that would connect them. In Sweden back then, analyst investors were more accustomed to being able to just call the CEO and say, we want to chat about this and that. And the financial market wasn't as developed as it is today either. Finance wasn't as big of a thing in the early 80s. Today everyone owns shares through their smartphones. Back then it was a very limited group who actually traded in shares. So it's a very different context.
Yeah, right. And just to, I think it was, so early 80s would be pre sort of privatization, a lot of privatization initiatives as well. Yes. So a lot of stuff did change.
But also partly technologically wise.
Right, of course.
Early 80s, it was still, I wouldn't say manual, but it was, really, really early in kind of the trading scene. But the Americans then, they expected an IR officer to be in place. There are some international historical analysis of the investor relations profession, one in particular from the US, based on documents then. And the early one seems to be even in the 50s in the States. But the way they describe it was more of a kind of PR thing, just communicating things. It wasn't the profession we know it today. So really also internationally in the early 80s, that's when it was becoming the profession we see now, that the accounting, finance, communication mix.
Right.
So even though we copied a lot of what's happening internationally, especially UK and US, it was a time where a lot was happening also on a global level.
That's interesting. So, okay, so you're taking obviously the Swedish perspective in this study. Have you considered if you wanted to extend that into different countries or
not really? There are some commentaries internationally as well, but I there's only so much you can do, and for me it's very important to contribute to Swedish practice. I mean, I'm my entire academic career has been funded by Swedish money in a sense. I owe my academic career to Sweden. So part of the third assignment where we give back to society, I want that to be focused on the Swedish setting. It's not a necessity, but I find that more interesting.
Yeah, sure. And I mean, that makes sense. And I guess in this setting as well, you will still have a lot of international connections because I mean, a lot of the owners are still from other countries.
Oh, obviously. Yeah. And I think investor relations today, if you're a Swedish investor relations officer, you travel the world. Obviously, you go where the capital is. And I mean, it's not only in Sweden where you find capital, quite the opposite. You find capital in the US, you find it in Europe, you find it in Asia and so forth.
Yeah. Okay, so that's interesting. The anecdote from Mats Ödman was definitely a good one. Yeah, it was for sure. So why do you think you're doing like this specific study right now? To put it a bit more, let me have it changed in a way with technology and everything, and how investors perhaps make decisions that has made the investor relations role either change completely, or just it is more important today or less important, or where do you see that change?
No, not necessarily. I think that we haven't given this function enough focus, basically. I think it's been a little bit under-researched, and it hasn't been researched in the way that I want to approach it, mainly as its own profession, with its own investor relations strategies, with its own aspirations.
Right.
So I'm actually supervising 3 master theses on investor relations right now. And they struggle a little bit with their literature reviews because we haven't targeted in that way really as its own profession. And one of the things that one of the groups have noticed is that when investor relations officers are interviewed, they are seen as an example of top management rather than something of its own, like someone who thinks and acts the same way as top management.
Right.
And of course, it's a distinct profession. So I think that's why we want to emphasize that more now. We also see a demand from our students to learn more about this. They are quite excited about this. In my course on financial communication, we usually have a case on investor relations, and our students are really excited by that. So we see that more want to work in this realm, which is, it's interesting. You need to know accounting, but you also need to be social and know communication and so forth. And then kind of to answer your question, there are a lot of things happening right now, but it's quite similar as many other professions. We don't really know what's going to happen with AI. What would that happen to a profession that's really traditionally based on face-to-face meetings and going around the world, meeting investors and so forth? And then, of course, it's happening a lot in the sustainability field, which would change regulation and new information and so forth. So it is certainly changing a lot. But to some extent, anytime you go into profession, there's a lot of changes.
Right. Yeah. Yeah. Of course. Yeah. Thank you for that. But if we try to sort of pin down exactly what the IR officer is doing, I mean, it is they. Correct me if I'm wrong here, but they do not produce the information, right? Because you have accountants and you have auditors and all that stuff, and how the reports are supposed to look is regulated, etc. And then obviously the strategy of the company set by the board and the CEO and financing decisions perhaps made by the CFO.
Yeah.
So in a way, I guess you could say that the IR officer is sort of mediating or sort of, they are in between the investors and the company, but not really contributing anything by themselves. That is perhaps a harsh stance.
I think that's too harsh.
Yeah, but if we take it to the extreme and sort of go from there.
No, but partly the job description of an investor relations officer or an investor relations director. So nowadays they are, I mean, when the interviews I did from the 80s, then there were one person. Now they could be a team of 5 perhaps. And then you have a director who's usually very senior, part of the kind of the group management, a senior vice president or something like that. And then you have IR officers, IR managers, IR administrators. So it's become more professionalized in that sense too. But it's not necessarily a homogeneous role in all organizations. So they are, to some extent, project leaders for kind of the quarterly reports, some of them. They're not only mediating the capital markets and the company, but also very different functions within the company. Top management with kind of regional managers, or different, accounting with communication and so forth. But to some extent, I mean, some write the quarterly report. The numbers in them are regulated, of course, and that's produced by the accounting department, verified by the auditors and so forth. But there's a lot of information that isn't. And as we all know, it's not, one number doesn't say too much. So there's a lot of other things that needs to go around it. And I think that's really where the investor relations officers add. And they create a narrative, the equity story around this, which is important both for external purposes, but also internally. It's wonderful when we speak with kind of investor relations consultants who work with companies who are kind of, okay, in 2 years, we want to go to the stock market. How much they work to change the company. Okay, but who are we? What's our focus? What's our identity? That's a huge part of the investor relations job, actually. And then on top of that, you also have kind of, as I said earlier, that you have investor relations strategies, for instance. Okay, which investors should we target? Which markets should we be at? Where do we get most bang for our bucks in terms of our communication and so forth? I'm sure I forgot a lot of different things, but they contribute quite a lot, I believe. And I think it's very clear when you see the emergence of the profession that Swedish companies was probably not getting a fair valuation back then. So, I mean, stock market development isn't necessarily value, but you can really see that being transparent, being consistent, being trustworthy, it added many dimensions to this.
That's really interesting. And I mean, perhaps you could even say that the growth of the role of the IR officer, which would be to perhaps hone the message itself coming from the company, but also educate the investors on what they truly are. And hence you sort of reduce information asymmetry or uncertainty in the market. And perhaps that can even give you higher valuation or lower your cost of capital, etc. So there's obviously the information aspect, it's really of incredible value.
And as you said, the cost of capital, I mean, it's truly a way to make sure that you get good financing. And that means that you can grow, you can invest more. And even though they usually focus on the equity side, I mean, if you have a proper valuation on equity, you also have better debt terms. So it's certainly, it influences everything.
Yeah.
And we've seen so many examples of poor market communication and how much that damage a firm and the valuation of it.
Yeah, that's true. Okay, so we have a better understanding of sort of the value that they add. So thank you for that. But what do you hope to sort of get out of this? Let's speak specifically now about the historical study.
Yeah. So the historical study is I think it's always interesting to see the birth of a profession, and that's not my words, that's my respondents' words. I mean, we're really the birth of a profession, and to see what came about, or how did it come about, and what were their concerns, and how did it kind of change the organizations as we see it. So I would say I'm driven a lot by just the personal curiosity, but on a theoretical level, I think that's interesting. How does a profession come about? And particularly in this case, it certainly is a hybrid profession. We have studies of hybrid professions earlier, kind of doctors who also need to have accounting knowledge, so that becomes a hybrid. But I think it's so ingrained in this that they truly are a hybrid, and people still today come from different backgrounds. They have communication backgrounds, or perhaps accounting background or finance, or whatever, but they come together and become something else. I think that's very, very, very interesting, and it's very telling also of, by looking at this professional development, it's also how organizations developed and how their views on capital market developed around this time. One of the things I asked many of them was, since they were so young, did they experience any problems with that, kind of power-wise or authority-wise? And none of them has really thought about that. And the classic response is more like, no, but the entire financial industry was so young. The analysts were so young. Everyone was, everything was happening so fast, and it changed, and we just went with it. I think that's wonderful.
Yeah, it is. It sure is. That's really interesting. Yeah. So do you think is there a gap between what an IR officer ought to do and what they are doing, in your view?
I think my view is more that we don't really know enough what IR officers do. We have the kind of classic school book examples, but we know from any other professional study that that's wrong. Right. That's a very clean view of how they work. And I think there are much more to learn, both kind of how the organizational identity, the organizational knowledge reaches the capital market, but also the other way around. How does the interactions from the capital market influence organizations? And we have studies on that already, but I think there's much more to learn there. As one of the master theses that I was supervising did just that, and see that, if we don't look at investor relations on their own terms, we forget an important actor in this mediation between the two. And mediation is not neutral. There's always something happen when you have a third party in there. Yeah. So how do they influence? It's super interesting.
Yeah. And I guess we touched upon it a little bit, but if we go back to sort of the historical perspective again, one of the reasons, to my understanding, correct me if I'm wrong, was that the IR officer, or that role, was created also to simply alleviate some pressure from management, or CEO and CFO, because they were, being called down by investors, etc. And then, so it was simply just adding someone who could do something, and then it grew into something very much more valuable, I guess, over time. Because so you can go from something, simply adding a role that is just supposed to give management more time to focus on other stuff. Yeah. And then you can go all the way to perhaps where we could see the IR officer role today, where it is to reduce uncertainty about securities in the market. So I mean, that trajectory is really interesting.
Yeah, I think that trajectory was always there, or kind of the asymmetry stuff, the comfort stuff was always there, or at least very early came there. But as you said, the early news articles, the first news articles about this emerging in Sweden, it was truly that the first interview with Mats Ödman, it says something like, top management needs peace of mind. They cannot work. International investors come, every month, and we have to, someone needs to take care of this. It was really this atmosphere at the time. But I think it took a little while. So 81 was the first, 83 was the second, I know, and then a couple emerged in 85. So it took a little while before organizations really started to see the value of having a distinct function on this. Mats, for instance, and then as well in Pharmacia, he was placed in the US. Oh. So and many others were, for instance, in other companies as well, were also placed abroad. It also shows that the world wasn't as connected as it was.
Sure, of course. I guess you wouldn't see that today.
No.
As much.
Well, there still are. If you have a strong investor base somewhere, you can have a person there. But then it was
because investors prefer the face-to-face meeting.
They still do. Yeah. There's something about face-to-face.
Yeah.
I think if you just look at how the research field on investor relations, or how in the accounting domain, how we approached it, it really was from that angle. So traditionally, when you've done user studies, okay, what do users find most valuable? They interview or survey investors and analysts and other senior users. And then it's typically a list that they can rank. What's the most important information?
Right, yeah.
Is it the balance sheet, or is it the, whatever?
And now we're probably talking late 90s, these kind of studies.
No, early, it was also around the 80s that they started to emerge.
Even that early? Okay.
Yeah, that early. Because it was also, this was a shift in how we viewed the kind of the importance of relevance for accounting. So if you look at IFRS, the global framework for accounting, the kind of main features of accounting should be that it's a faithful representation. So you cannot make a false representation. But the second one is it should be relevant. It should be relevant for users' decision making. And also then in the 80s, the relevance became more important. Okay, but then we need to know what's relevant, right? We can just sit on our offices and think about what's relevant. We have to explore what's relevant. And then they did all these user surveys. And very consistently, the users said the most important source of information are these direct meetings, direct contacts with top management. So basically the investor relations meetings. And we can all understand that there's a value to seeing someone. An email is worse than a meeting. An email is worse than a phone call, and a phone call is worse than a meeting to a certain extent. So we understand that. But it was theoretically interesting because we had to start to think differently about information.
Right.
The classical way we theorize information is that it's price sensitive. It impacts the markets, the stock market, meaning that an investor has made a decision on the basis of that. And then we can see if they correlate, it should have information contact. However, regulation is quite strict on these meetings. You're not allowed to say something to someone to get private information. So here you have a dilemma, and we academics love dilemmas. So on the one hand, users say it's the most important source of information. On the other hand, you're not allowed to produce too much information there or disseminate the information. And this is a very, very good study from 2012 on this dilemma.
Right, the one by
Richard Barker and John Roberts and their co-authors, kind of exploring this dilemma. And then they basically have three explanations, and they say all occur to some degree. And the first one is that, it's so difficult to do these calculations. So we need help, basically. It's doing a DCF model.
By calculations, you mean
doing a DCF model or evaluation is so difficult, so we need help to kind of organize it. That could be one explanation. Another one is that not so much happens in the meetings, but if you have a meeting, you're able to tell your own client, as a fund manager, tell your investors that, no, we had a meeting, we have good contacts, you can market your own expertise.
Right, yeah.
And the third one, which I find perhaps most interesting, which has been part of my career now, is that, well, maybe we need to re-theorize what information is.
Right, yeah.
And we know that something goes on when we meet face-to-face, when we speak with someone. But it's very hard to dissect what it is. And it's very hard then to, okay, so we know that your kind of comfort level or how you present yourself matters in communication, but is that price sensitive? What's the limit? Okay, if someone looks nervous, have you been given private information then? Super interesting questions that we're just kind of beginning to explore. There's so much still to do here. And the problem is that if we don't see information in the traditional way, we have huge problems in how we would evaluate what's informative.
Right.
Differences in accounting sources, for instance, it's usually seen as, okay, the most impact means the most information. But if we have other, it opens up a lot of new ways we need to think about these things.
Yeah, sure. I mean that's really interesting. And this is obviously, I guess we're sort of going into a bit about the sort of typical qualitative capital market research, where you mentioned the third one, which is could it be relevant for even making these kind of decisions, even though it's not price sensitive information.
So
but
we have studies here also. One of our colleagues, Niklas Hellman, one of his early articles, where he was on site in. I have to remember this properly, but he was doing some sort of ethnographic research, being on at an investor, a fund manager. I might need to correct this, but it's something along these lines, where he really traced the investment decisions. Okay, so what is it that trigger investment decision? And he couldn't link that to the release of new accounting information. So that also puts things to an end. Okay, so it's not like, okay, you get an accounting report, you make your analysis, you buy a share. No, that's not how it works. There are a lot of different things that triggers that. And that opens up a few problems for us as accounting researchers, especially when it should be price sensitive, relevant. You should act on it. But it seems to work in many other ways.
Right.
More subtle ways.
Yeah. And you touched a bit about the IFRS and the relevance and that stuff. But perhaps we should make clear who the intended user is, because we have talked about the investors. And so when I guess usually users are investors, right?
Yeah. So
sort of assume that it's the investor we're talking about, or
so they're according to IFRS, they need to be sophisticated accounting users. So it's not anyone. You need to have some sort of knowledge about these things. And it's specified it should be capital providers. So it's then either investors or lenders or creditors, which are in focus. But we usually focus on the investors. There are not as many studies on the creditors or lender side. And then in an extension of that, because those who really make these kind of big decisions, the investors, they are not always easy to get a hold of. So a lot of the research has been on analysts, because the analysts they're more open with their views. They publish investment reports. So they've often been treated as surrogate investors, as if they think the same.
It's simply easier to conduct research.
It is truly, yeah. And then you also have a measure. That was really important, also kind of back in the days, that you had a measure of how much information was already absorbed in the market, because you had the analyst forecasts. When they were started to become published, you have a measure of what do people already know, right? And then you can do the incremental information that comes with an accounting report or a shift in reporting choice or something like that. So that's been very important as well.
Yeah, that's really interesting.
Yeah.
So we touched a bit on the sort of information thing. Maybe we should say something about that. What if I define information as something simply that reduces uncertainty? I'm not talking about information as something that's meaningful or relevant, but simply as, if we take the assumption, it is only to reduce uncertainty.
Okay.
And that's sort of the basic level.
Yeah.
And then I guess if information which reduces uncertainty is released to the market, we should see some kind of decisions taking place simply based on that, or a change in
basic. So your example would be something like that. So first the CEO says, we believe that X will happen. Next time they say, we know that X will happen.
Right.
Yeah.
Right. Okay. Yeah, exactly. Exactly. You could go from uncertainty to risk, for instance.
Okay.
So if you have a situation is uncertain, we don't know the outcome, right?
Yeah.
We cannot add any probabilities to this. And then you release some information. So you take the situation from uncertainty into risk, where you can say, well, it probably will go this way or this way.
Okay.
And in that sense, you can include that information within a model. The analysts can adjust their valuations, I guess.
Okay.
And in that sense, information is always price sensitive, right? Because if it reduces uncertainty, it's just a theoretical thought process I'm trying to come up with here.
Potentially,
But in the Barker study and this face-to-face meeting, what's interesting is they make the distinction between price sensitive and valuable information, and there's a difference between that. So can you perhaps elaborate a bit more on why it's valuable but maybe not price sensitive?
I don't dare to do that. I don't remember the article that much by heart.
Yeah.
You should have them on your podcast. They're very.
I would definitely try.
Yeah, you should try actually. Yeah. So I will save that question for them.
To me, it's just a very interesting concept at all. If we try to sort of first go down to what information really is, and then you can go from there to try to actually see what the investor relation officer is doing as well, because it's about information, right?
But you always have, I mean, uncertainty is always impacting the information kind of level out there. So one very common metaphor that's been used now for how to make sense of these investor relations meeting is that an investment case, or kind of the general idea of the firm, is an information mosaic, meaning that it's made up of 1,000 different pieces, and skilled people need to be there to organize it. And when you get a new accounting report, you get a few new pieces that you need to have something, or you need someone to organize that for you. And then, of course, as an investor relations officer, you are really a puzzle. You lay the puzzle. You help lay the puzzle.
Oh, interesting.
And
that's a good analogy.
It is really good analogy
to explain their role.
Yeah. So I think, I mean, it's been used in many different ways, but John Holland has been one of those that really used it in various papers. And the idea then is that, well, how can private information or meetings be relevant? Well, it's the entire information is already out there publicly, but public information, like an accounting report, it's too abstract, it's too impersonal. So it's the careful mixing of these information sources that makes something value relevant. Value relevant is another way of saying price sensitive, that is relevant to the evaluation of the share.
Right, so, and in these, sorry for interrupting you, but okay, so in these face-to-face meetings, no new information is obviously released. It shouldn't, at least.
It shouldn't be, yeah.
Simply due to regulation, right? And no price-sensitive information, that is. So what the investors do, or analysts, or who the party is who actually take part in this meeting, they try to make, I guess, some kind of subjective assessment of the management team.
Yeah.
And based on that, they can extract valuable information.
Yeah. Partly about that, do they have confidence in that these people will run the company in the best way possible? But it's also, so one of my older studies, one of the things that the analysts said then, they called it a collection of experiences. That's one of the way they legitimized the value of going to these meetings, both private and public, in that the management is quite good at keeping a straight face, not giving away stuff. But eventually you learn the nuances. So if they say something, you remember that 2 years ago they said a similar thing. Okay, so the trend is slightly positive. Well, if you've been following the firm for a while, you know what slightly positive means. You could probably even set a number on that. Whereas if you are a new analyst, you don't have that collection of experiences. So it is really about getting to know these people really, really well. There's a wonderful quote also from one of my studies from an investor relations officer or director who said something like, okay, if we go out and say that the next quarter will be unchanged, what does that mean? You have three problems. You first need to see, okay, does it mean unchanged from the last quarter? Or does it mean unchanged from the same quarter the last year? Or do you mean unchanged as it normally is? Basically, that is some sort of seasonal effect. And then he says very clearly, like, if we're not clear on this, we will get a billion of questions. So even a word like unchanged, which we use regularly, is so loaded. And it causes so many questions for these people, or concerns for these people, which is really fascinating. And that, I think, with the investor relations officer really comes in, is that they are... they're really the keepers of the narrative. They know how they formulated this. They know what to say, when they can say stuff.
Yeah, for sure. I mean, but wouldn't that lead them to, in a way, if they're so competent and have these skill sets and they know exactly what to say and what not to say, when to say and when not to say stuff, wouldn't it be that sort of diminishes the scope of what kind of information that can be released from the investor standpoint? Like, because it's so, I guess, regulated in a sense, simply by their experience. Yeah,
I mean, there's always a lot of concerns in this field, in finance in general, that is over-regulated. So it might be. I'm not too concerned about that. There's been some concerns now with CSRD, with the new sustainability,
right? That
this would lead to something like that they cannot tell the story they want to about sustainability, but it has to be more formalized. And if it's the same narrative all the time, why would we have... I mean, if everyone says the same narrative, what's the value we can add?
Mm.
There are certainly concerns about that, but I think that's just one of the many unanswered questions which we don't really know yet.
Yeah, maybe you can. Have you learned anything from your interviews or your studies that you're conducting on IR when it comes to the new sort of information demands that's coming? So you mentioned the CSRD, sustainability reporting, and all that other stuff.
No, I mean we have one of the master theses was also about sustainability, so we get some insights. But I think that's one of the big unanswered questions. It's interesting right now because it's been a move towards more green finance. For a while, we know it's important. We know we need capital for it. We know we need to make business cases for it. And now at the same time, there's a little bit of backlash where we see with investments that haven't worked out, etc. And a lot is happening, both kind of in the real space in the terms of kind of business operations. We see projects fail more than we were expecting, for instance. And at the same time, we see a changed information environment, more standardization and more demands put on firms in terms of how they should communicate these things.
Yeah.
So I mean, that's something we truly have to follow now the next 2 years or so. It's going to be so much that's happening there. I think it's going to change. One of the things that I think is interesting from my studies of the 80s, 90s is that on the one hand, a lot of things have changed. Technology has changed a lot. More people work with this, where more the regulation has changed and so forth. And at the same time, a lot is the same. So I think the entire investor relations field probably need to think a little bit about innovation, for instance. How do we innovate this field? And external threats are usually a good way to innovate. So CSRD comes now with, or AI. Okay, how will that impact how we view investor relations 5, 10, 20 years from now? Probably need to innovate in some way or another.
Yeah, for sure. And I mean, just with the sort of trajectory that we have been on for decades now, what we see is obviously this is known to everyone, but the just sheer number of data and information is just insane. That's being
and the ability
produced.
to process that amount of information.
Sorry, say that again.
The ability to process that information as well.
Yeah, exactly. So just being the ability to produce that information or make sense of that information from the company standpoint, and then the ability to actually make sense of it from the investor standpoint. It's just, are we not in a position where it's just too much? There's overload out there.
Who knows? Potentially. I want you to look at, there's a very nice archive of annual reports from the Swedish House of Finance that they produced. So you can go back, how decades ago, what an annual report looked like. We also have a book at the department that the colleagues of ours has written about the development of annual reports. And, 70s, 80s, it's a pamphlet, more or less, 20 pages, and, you can read it in an hour. And today it's hundreds of pages, and the information is endless. And of course, the annual report is one thing. Then you have the entire internet, and there's so much information out there.
Yeah.
At the same time, we also have faster means of processing the information. I mean, maybe that's one of the key ways that investor relations has developed also over these decades is the help with sorting. Sorting has been more important, or filtering or something like that. Maybe with the increase of AI, maybe things like authenticity will become even more important. And in the course we have on financial communication, we speak a lot about authenticity, about being able to produce a message that feels authentic. I mean, maybe that's the role of investor relations now when we move into an AI environment, where information not only is cheap, but can produce novels in seconds. So maybe, the role will change undoubtedly.
Yeah. I wanted to ask you about something else, and I mean, this is something that's been going on for many years, at least in terms of the change when a lot of companies went from their most sort of cash flow producing assets were machinery, and now today you have intangible assets and brands and technology and stuff. So you can, I'm sure you're aware of the book named End of Accounting by Baruch. I think it was released in 2016. It's based on a lot of research they've done before, but it basically says that the value of accounting has diminished. And today, accounting is able to explain a fundamental value or let's say share price of 5 to 6%, and in the 80s it was 40%, and in the 30s it was 60%. Don't quote me on the exact numbers, but sort of trajectory, the trend over time has been diminishing constantly. Are we in a place where the information from accounting specifically has really no real value?
Well, you can see that in different ways. So Boruklev is one of the, I haven't read that book, but he's one of the real kind of big names in the field of intellectual capital, which was big or emerged in the late 90s when they really were concerned about the things you were saying, that market values were so different from book values. So that showed that there were either a lot of assets that weren't on the balance sheet or they were undervalued, basically. So for long now, we've been speaking about the hidden balance sheet where competence lies or relationships or market values in general lies. And the problem then is that would diminish a report's relevance because there's so much you just don't know about. I mean, that's partly true. There could be value in putting other assets on the balance sheet, but the way we often see this is that if this becomes a little bit technical, but let's say that you would have perfect market values on your balance sheet so that every day you look at it, it's the exact market value. First of all, then you would have to outsource accounting to the stock market, basically, because you would need to see the stock market value as the real value. You would have huge problems otherwise to find any real value, which means it would be very volatile, and it would be you would be caught in this kind of circular reasoning when users use accounting to try to make an investment decision, but investment decisions are already part of the, it's continuum, it's a self-referencing system. So that's part of the problem. But the second one also, so we have more fair value in accounting than we had in the past. For instance, with real estate, what's the I can't find the English word now, but real estate is fair valued, and also biological assets, so forest or salmon farming or farming in general. Biological assets would also be fair value. And the problem with...
perhaps that is because you can observe market transactions taking place and you can use fair value for those specific assets.
But if you look at our big forest companies, you don't have a market value on the huge scale that you have in terms of the assets you own. So you don't really have, it's always an assumed market price, nevertheless. So the hierarchy is that preferably you would have a market price. If you don't, you should find a market price for similar asset, or third, you would make a model. And usually it's a model.
Because, level 3 fair value.
Exactly. So usually you make a model. Where I was going with this is that if you have the perfect balance sheet, the problem is that your income statement becomes something else then. So then it's...
Interesting. How is that?
Yeah, so I can't remember now. I mean, I haven't been thinking about this for years. I didn't expect the podcast to go this. This is wonderful. It's about value theory. So what is income? Basically, what's profit? And traditionally, it's been transactional based. You sell your goods, you have your expenses, and then you get a profit. However, you could also see profit as the value increase you've had over the year. So if you look at your personal finance, part of your kind of wealth comes from your salary and the money you save. But part of your wealth is also because your house appreciates in value. Right. So if you have market values on the balance sheet, you would probably have to have those value increases in the income statement, which you now do for real estate.
Yes.
And it's called something else than real estate. It's property. I can't remember the name now.
But me neither right now, sorry.
But it's not
Perhaps I should know this.
Yeah, probably I should as well. It's not your own offices, but if you're a real estate firm, it's the property that you own to rent out, basically. But also biological assets then, like forest. And what you see then is that the value change ends up on the income statement. And in a real estate firm, the assets are enormous, whereas the revenue is quite small. So what ends up happening is that your entire I mean, your value change, which becomes an increase or decrease in the income statement, can be as high as your revenue. And then your income statement becomes less relevant in that regard for forecasting purposes and for analyzing the underlying operations. So my perspective is more that you need to pick if you want to have a good income statement or a good balance sheet. And it's not only mine. So Stephen Penman, for instance, the kind of guru on this, he's written an article on that. Well, there's also an income statement.
Yeah. That's great. Really interesting.
It really
appreciate that perspective. Johan, would you like to say, is there anything else within the sort of investor relation topic that you would want to add to this?
What I believe is interesting in the investor relations domain right now. So it's partly how will the future look now when we're a little bit forced to innovate in relation to sustainability challenges, changes in sustainability frameworks, but also technology like AI. So there will be innovation. What will that look like? I think that's super interesting. And perhaps some of the things that we are more concerned about, right here and now and been for quite some time is, okay, how much everyone just wants to do their best efforts. So we want to be as pedagogic and transparent as we can to investors. However, that can backfire as well, because we're too transparent. It's still about the future. We never know how the future will end up.
Right.
So that will also be backlash. It can increase the insecurity if we're too transparent. So I think that balance, how much do you really say and disclose towards how much do you keep for yourself for now? I think that's a dilemma that practice is trying to tease out.
For sure. And sounds very difficult.
Extremely difficult. Yeah. And there's no blueprint for how you should do this. So one of the things that's been in the media a little bit is these kind of things. It's called analyst massage, pre-close calls. Basically, you have a silent period where you don't communicate anything before an accounting report. But then before that, some companies choose to actually have a conversation with all their analysts right before that ends to see, is someone way off? What are they thinking? What are they worried about? And the concern then is that you massage them a little bit too much,
right?
Basically give away little information. So that's one thing I think is interesting. Another thing is that more voices are present in the capital markets. Back in the days, it was very much one-way communication. Now, which we've seen with the GameStop problem, for instance,
right?
Private investors with very little resources can make huge impacts on the stock market.
Yeah.
Okay, should investor relations or the firm, should they engage with that? Should they be on the forums, chatting and say, I don't know, maybe? That's one thing they need to tease out. And there's also a huge rise in kind of these activist short sellers that they are very strategic about this, how they go about and publish negative news about the companies. So in hopes that the share price will plummet. And they seem to have strategies in terms of, okay, let's throw out 1 million arguments and see what sticks. And then we go from there. And that's very difficult for a company to counter. And they also usually do this in the silent period where they're not allowed to comment on it. So how do we deal with that? How much do we confront different narratives? How much do we manage them? We had a guest in one course, and it's obvious when you hear it, but I hadn't thought about it. But she said she's an investor relations director, and we never comment on rumors. And it makes sense, but my first instinct was, but what if you know it's false? Yeah, but you cannot say that, no, that rumor is false, that rumor is false. And then there's a rumor where you say, well, I'm not going to comment on that because everyone knows what it means then.
Yeah, that's true.
So how much do you engage with it? It must be so frustrating when you know that there are wrong pictures or lies even that circulate and you're not allowed to deal with it. One thing that is interesting, which has come up now with some of these activist attacks is that, or short seller attacks, is that you also have friends in the capital markets. So those who can speak in silent periods investors, fund managers, analysts, they come and support the company.
Like ambassadors for your company in a way.
And kind of, so especially analysts have fronted now and say that, no, this is wrong, they have misinterpreted, so they can comment on behalf. It's super interesting.
It is.
Which also shows the value in having investor relations. You build relationships, you build friends. It's a give and take then. So, with any kind of relationship, you have to be, you need to do well, because you're going to work with these people for decades potentially.
Yeah.
And now we're seeing when in tough times, we then also have these relationships back as a resource.
Wow. Yeah. So a lot of dilemmas.
A lot of them.
Some of them, I mean, most of them have probably existed since the start of this role.
Oh, certainly. So when you go back, that's also why it's always nice with history, is you see that there are some dilemmas. So this analyst massage, it was mentioned already in 87, I think, as a problem. And that shows that these are eternal questions. It will not be solved by AI. It will, in 40 years, we'll still speak about the problems of giving too much or too little information. They're eternal questions. And it's interesting to see how we deal with it differently in different phases.
And I mean, it just got me thinking about the fact that the company itself can actually decide on which analysts are able to take part in these perhaps pre-release meetings, or even those who are allowed to actually ask questions during an earnings call and stuff like that. So there's a lot of places where company management have discretion in these things, which can be for the good. Can be bad as well for other investors or those who are excluded, I guess.
Yeah, so that's the key assumption in a lot of the literature. Often the quantitative literature that this plays more role. I think that to some extent, if you compare the financial markets now with 20 or 30 years ago, it's not as well funded as it used to be. Kind of the fees for funds are going down. There's not as much money available. It's still a lot of funds, but they don't have as much money to do their analysis. And that in terms impacts the sell-side analysts, where commission fees, basically their income, has reduced a lot as well. So I don't think that companies are, this is maybe me speculating a little bit, they can't not be too picky and choosy, because there are not that many analysts following you. So it's usually in an investor relations webpage, you see which analysts are following the firm. And my feeling is that you have quite good relationships with all of them. You need to be a quite difficult analyst, I think, if you're not part of the kind of normal communication.
Yeah.
Investors are different because they're usually thousands of potential investors. So then you need to be more strategic with it. Some firms don't allow hedge funds to meet with management. Other firms allow everyone to meet with management. Some focus on, long investors, pension funds and so forth, because that suits them. Some companies are more like a bond, it's just, it ticks on and you give dividends. So that suits some certain investors. So I think they're more strategic in that regard. Who do we communicate with and for what purposes?
Right. So having that discretion is something that should be there. It shouldn't be regulated in the sense that they should.
No, I mean, they have discretion, but discretion, it's like gift giving, a classic problem in sociology. A gift is never just a gift. If I give you a gift, that comes with an expectation that you give something back, right?
Yeah.
So a relationship is kind of two ways. There's a codependency here.
Right.
And I know that analysts acknowledge this. My best guess is that both sides acknowledges this codependency and the value in having a good relationship. And then, of course, it cannot go out of control in any way. But I think a lot of them, they're all in the interest of having a fair valuation of the share. And as little surprises, as little volatility, unnecessary volatility as possible.
Right. But I mean, and that's definitely something you have done research on before, when specifically the paper where you investigate earnings calls, and you could see that they are perhaps not as straightforward in their critique.
No,
and they cannot be, because I guess there's the balance between they might lose face in front of management, or simply just, we don't want this guy. He's always asking putting us against the wall and making us feel nervous on the earnings call or whatever. I guess there has to be some kind of tension in that relationship, right?
One of the things that's interesting with the Swedish setting, so this was part of a study I did earlier as well, on the meetings they have after the report release. So this is not common in all contexts, but in Sweden, we usually have a face-to-face meeting. We invite it to a nice place here in Stockholm. Everyone is invited, and then it's also webcast at the same time. So everyone who's internationally can listen in, but something happens here locally, and it really is a stage performance. So on one hand, you get information, you get insights, but it's also about presenting yourself in the best way possible. And this something happens when you're physically in front of an audience, for instance. So I think it's an old Shakespeare quote that like life is a stage. We're always just performing at all times.
Yeah.
And the conference call or the presentations that are interesting because you have to perform in front of several audiences. You have to perform in front of management, and I'm speaking of from the analyst perspective.
Right.
So the analysts need to perform in front of management, which they want to have a good relationship with, to have access to information and meetings and so forth. But they also perform towards their clients, the fund managers, who, then you should display some sort of objectivity and perhaps being able to be critical. And then also to various colleagues, both other analysts and also kind of brokers or equity sales who communicate your thoughts. And this causes some dilemmas.
Yeah.
So usually it's a quite smooth performance, but you can see that sometimes the analyst is much more junior than the top management, and even though they should interrogate them, it's a little bit of there's a lot of tension going on there. And what I saw in that study was that analysts faced some role conflict here, and the biggest problem was when the companies didn't perform as they should, when they had a big surprise, for instance, or when they stopped communicating something they usually communicated, because the analysts were then expected to be a little bit tough on them. At the same time, it's quite it's very, very, it's a lot of social dimensions at play there.
Yeah.
And one of the kind of conclusions from that was that they had mechanism to sort out that tension, and especially what happens when the camera is closed. So you look a little bit tough on camera, but then when the camera is closed, you become friends again, or you kind of have a discussion again.
You gain the confidence back, and
you show that you're a sane person, but it has to be done, etc., etc.
Okay.
And it can be quite awkward at those moments. One of the first one I observed, the CEO was quite harshly questioned on, I think it was low performance in that case, and that's quite unusual, but it can be quite uncomfortable because something has happened. Let's say they guided for a substantially higher earnings performance, and then it's a huge negative surprise. Well, what happens? You cannot just, applaud them then. You have to play the role of an interrogator.
Yeah, sure. And I guess in the specific Swedish context, we are perhaps not the most confrontational people out there. So stepping into the interrogator role is probably a bit more difficult as a Swede, I would assume.
Culture plays a huge role here. And that's also, I think, one of the things we touched upon earlier was, the value of face-to-face versus, distant, is that of all my problems professionally that has ever emerged in my career, it's always been due to emails, miscommunication, and then emails back and forth, and then meeting over an email. So it wasn't my intention. Whereas in face-to-face, you can dissect a little bit better what the message is. But it's also that you behave a little bit better. Sometimes you write an email that you shouldn't have written. Yeah. Right? There's something happens face to face.
Yeah, we've all been there.
I'm sorry, my friend, this has been lovely, but I think I need to start to wrap this up.
Yeah. I mean, there's a lot of stuff I would love to talk with you about, but
which we will over the years.
Sorry?
We will over the years.
Yes, of course. Yeah. Of course. Thank you, Johan, for taking the time to talk to me
so
today.
Much. It's been so much fun.
Yeah, this was a lot of fun. We definitely need to do this again.
Time just flew away.
Yeah, it did.
Yeah.
It did.
Thank you so much.
Thank you.